is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Vishal Arora, a tech executive and investor with a background in global IT companies and venture capital. As managing partner of VDosh Capital, he leads investments in early-stage deep tech startups, combining technical and strategic insight. VDosh operates as a selective early-stage VC platform in California with a strong focus on tech-driven innovation. Vishal, thank you for joining us.
Thank you for inviting me, Hall. Pleasure to be here.
So where are you calling from today?
I am actually based out of Los Angeles, so mainly in the Los Angeles suburb area.
Great. Well, tell us more about your approach to identifying overlooked or underestimated founders in early stage deals. What do you look for and how do you find them?
So let me start by answering how do I find them, right? So at Vidosh, we basically use the little bit different approach where we have partnered with a set of basically channel partners across the United States. Either they are basically different incubators, accelerators, universities, pitching event organization or organizers, or some of the even those larger conferences where they have pitching events and things like that. So we have set of around 70, 75 plus different channel partners. So we have partnered with them. That was our initial approach, and we get a good source of deal through that, more than we can manage sometimes. But then as people started to know us, then people started to directly also reach out to us and also reach out to us through referrals. So that's how basically we started enhancing our basically deal sourcing.
Great. Well, tell us more about your investment focus on human capital and the value you place on founder qualities.
Definitely. So what we do is, which we invest at a very early stage, pre-seed, seed stage, right? We try to stay a little bit away from an idea stage because idea stage would go pretty much anywhere, right? But when you are in a pre-seed, seed stage, it's still the risk factor is very high, right? And when the risk factor is high, what we do is we have a phased approach, the due diligence approach that we have put together. It's our own proprietary approach where we start by looking at the 5 parameters. And these 5 parameters, the biggest contributor in that is human capital, right? So we look at team, we look at technology, we look at traction, we look at market potential, and we look at the revenue potential. So we look at these 5 parameters to see that where exactly the startup fits into that. And the human capital side is very important in that, because if you have a mediocre idea but amazing team, they will still be able to sell. But if you have a great idea but team is basically not experienced enough or don't have a good level of support system, then they will not be able to take further. So we do look at the team, their background, their experience, their network, their advisors, their ability to take this startup forward, leveraging the ecosystem they have. So human capital is very important aspect of it.
When you talked about 70 partner sources, exactly how do you source deals from underrepresented regions or founder groups? Are you taking applications or just go by word of mouth?
So most of the time it comes directly to us, but then what happens is when I talk about all these different basically channel partners that we have, they are actually based out of different part of United States. And these all companies that they are coming to us, they come through their ecosystem. So if either they have their cohort or they are pitching at their event, so we get the access to all of them. Also, we have some of the basically partnership with the local city level bodies, and they are sometimes running those entrepreneurship programs. So we get the deals from them as well as we get invited to their showcase and things like that. So that's how we are reaching out through these channel partners. If somebody wants to reach out to us directly, they can find us. They can reach out to us through our website. They can reach out to me directly, or sometimes if they also come directly through either the investment that we have done or the network that we have created.
Right. Well, tell us more about your framework for evaluating the pre-revenue startups. There's not much there in the early days, and what do you look for?
So as I mentioned that I have a very stepped approach. So I look at these five parameters in my phase one, where I look at team, their background, their experience, the ecosystem they have. Then I look at the technology, that what exactly they are trying to do, what problem they are trying to solve. Then I look at the market potential, that what market they are going after, how big that market is, what the competitive landscape looks like, right? So we look at all that parameter. Then we look at the traction as well, that where they are in their journey, whether it's the idea stage or whether they have a minimum viable product, whether they have gone through a product market fit, or they have gone through all of that and now they are basically going into the scaling aspect of it, right? And last but not the least is the revenue aspect of it. We look at from a two different angle. One, that the revenue potential as they basically move forward in their journey. And the second part is that generally we like to have a company where they have some level of revenue, but in an early stage, sometimes that is not a possibility. So we then basically also look for the companies which is, if they don't have a revenue, then they are entering into a revenue phase,
Right.
right? So these are the things that we do in our phase one. And after that, if we believe that there is a potential, there is a liking on it, then we go to the phase two, which is a very detailed, thorough due diligence we do. The earlier part is just the first phase of screening, but then our detailed due diligence part, we kind of do from legal to finance, review all the aspect of it, because sometimes you need to make sure that there are no liabilities, there are no basically conflict, there are the competitive landscape and everything, legal aspect. So we do the thorough due diligence across technology, the legal aspect, finance aspect, growth aspect, every single one. And then we go to the phase two where we negotiate terms and everything before we invest. So it's a phased approach, but it has served us very well.
So, what lessons have you learned from backing first time founders versus serial entrepreneurs? They both have pros and cons, but what have you found?
Very unique experience in this, right? And sometimes it's disappointing and sometimes it's exceptionally amazing experience working with the people, right? So it goes in both the sides of it. I think I sometimes try to avoid one man army or single founder companies, because it's not that easy. Entrepreneurship is not that easy. And if there is a one person, unless that person has a good experience or have done it in the past or has an amazing ecosystem around, that person will burn out, right? So we kind of, these learnings that we have around not to invest in, most of the exceptional cases are always there, but we try not to invest in a single founder. Similar way, if there is a complementary group, like I have one amazing company called Vui. It's a CPG company, and three young founders, and they complement each other so well that they were together able to take that company to the higher ground that they were supposed to take it to, right? So there are plus and minuses. I think you need to have a person who knows what they are doing, they believe in their vision, they are capable of taking a constructive feedback, learning from it and readjusting. They are able to leverage the network around them, right, to efficiently basically help them in their journey. So when we look at the founders, we always look at the person's ability to basically build that ecosystem and drive the growth, right? So those are the kind of qualities that we look at in a person.
Good. So, how does Vidash collaborate with accelerators, incubators, and university programs?
So what we do with them is that first we use this program as our deal sourcing mechanism. So we get all the deals from that we evaluate and potentially invest. So we do have that partnership where we look at the companies going through these programs. We look at those programs and potentially invest in those. Pretty much, I would say that 50% or more companies we have invested are through this medium. But parallelly, what we also do is that we basically kind of do the pro bono, offer our time to them to help this founder, coach them, guide them through, allow them to reach out to us for any guidance they need and things like that. So this is something we do as a our contribution to the community, to these accelerators and everything. Time to time we go and kind of take a session with them, tell them about what investors are looking for, how they should be doing a fundraising, what parameters they need to. So we, as much as we get those deals, as much as we learn from them, we also basically give them back in terms of our time contribution. And time to time, if we find the right companies, then we do invest in them as well.
So, what trends are you seeing out there in the key verticals there, say AI, health tech, and consumer? What do you see going on?
So I think nowadays everybody's talking about AI, right? It's not even you can't even move one step. And what amazes me is that the hockey stick type of a growth in this adoption or the talk about these technologies, because we were just talking about AI like 3, 4 years ago, right? And then comes to 1.5, 2 years ago, a wave of generative AI, and now everything is agentic AI, right? And I'm pretty sure that more and more will come. I think the way of what I look at is that everybody is nowadays there are two aspects of it. Everybody wants to do focus more on leveraging this AI capabilities to achieve some level of productivity and efficiency in their organization. So how they can do the cost saving to do more for a company, right? So that's the trend that we see, and it varies from a segment to segment. So I believe that AI is going to be the way of life in 3 to 4 years. We will not talk about generative AI or agentic AI. In my opinion, it's AI will become like a part of your day to days, basically expected behavior, right? Or expected jargons in that. But it's an amazing technology, whether it comes to productivity in workspace or productivity in like a development or productivity basically in many different areas. But on the other side, it also is very significant because it automates some of those day-to-day workflows, day-to-day things, right? It also provides more insight, like for example in a healthcare side, so many use cases, right? AI could potentially at some point, yes, you always gonna need a second eye, but can basically do the prediction or predictive prediction based on all the different analysis that they do about the basically different diagnosis that you need to do, right? Different basically parameters that you need to evaluate across so many records. So in a healthcare sector, in a business side of it, in a manufacturing side, everywhere AI going to be a part of it. And I think this is the way that like they already start talking about fifth industrial revolution, where they talk about human and machine living in harmony together. So I believe that we are going in that direction, somewhat in that direction.
Great, great. And so, tell us more about the role of community mentorship in your post-investment support at VDosh. How do you help the companies that you fund?
So I myself come from basically a technology background and have done a significant work with the Fortune 500 companies. We continue to basically keep those connections parallel, which kind of involves the connection across the large set of companies on their corporate ventures, business ventures. We also partner with all these incubator accelerators and everything. So what we do is through incubator and accelerator, we provide our time and our expertise to help a startup basically, yeah, have some level of ease into their journey, whether they are preparing for an investor or funding round or refining their go-to-market strategy. We can advise and we can provide the guidance in that with the funding and everything. But on the other side, we cover all the connection that I mentioned earlier and our own subject matter expertise of our people that we have. We also basically leverage that to open the new doors for them, connect them with the corporate ventures, business ventures, or sometimes we have seen so many startups that sometimes we believe that you start connecting the dots. Where is the hey, you should partner with this another startup because you have some complementary stuff that you are doing, right? So so we do a couple of things. We kind of contribute our knowledge and time in the ecosystem to help enhance the community and support the community. We also basically help companies either open the doors or connect with the people in our network in the industry that they are working on, connect with the different investors and things like that. So we have created that rounded basically ecosystem where it works both the ways and we contribute to this ecosystem.
Well, tell us more about your insights. You created syndicate and a micro VC fund. And what was it like doing that as a first-time fund manager?
It was challenging. It was really, really challenging. And I had to be very honest, come up with a very, very, I would say, I will use the civilized word called creative strategies around it. But because I come from a technology background, if I say I'm going to be a fund manager, nobody's going to trust me and give me the money. So I needed to prove myself as well. And initially, I started by investing my own money and things like that. But I needed to come up with a very strong and very simple to communicate thesis and approach to that, right? And I think not many people know that the first investment I did, it was actually a syndication, right, to the private funders. So I actually sourced the deal and went to the set of different investors within that syndicated group that I have, and then we raised the money. It took me a longer time, but then I proved that point that yes, we can be done. And then once that was done, the second, third, and the later on, basically, in the second we created a fund. We raised a good amount of money. We deployed that. We created another fund. So right now I'm on my fourth fund that we are currently raising. But it was challenging. There is a lots of proving that we needed to do, showcase basically the result that we could produce. And like if you look at it, how the traditional fund works, right? We needed to cut down on our fees and everything, and we kind of launch this fund in a way that we align our benefits with the investor itself, right? So rather than charging a very high management fee and everything upfront, we lower it down, but we kind of kept our margin with them towards the end. So then investor had a deep sense of confidence that I will make money when I make money for them, rather than me basically taking that money upfront. So we came up with multiple strategies like that. So it was our combination of proving ourselves, combination of our track record, combination of transparency, and combination of very reasonable, basically payment structure or the fee structure associated with that, which help us basically convince the right message and bring them on board. So it's a journey. It has been 9 years, almost eight and a half to 9 years. And I would say that it has been a tremendous, tremendous educational journey.
I can imagine. So tell us your outlook on how macroeconomic shifts are impacting the early stage venture investing. What do you see happening now, and what do you think is coming up next?
I think if you look at it, which I look at this thing is in three different ways. Like the impact comes from three different directions: technology, people, and the processes, how you do things, right? So if you look at a people side aspect of it, when we talk about an investor, nowadays, because of the market condition, what's happening with all the tariffs and everything, and global ecosystem with the war and everything going on many places, right? People are little hesitant. So I have seen little bit slow down, especially when you talk about an credit. HNIs are fine, but when you talk about accredited investors, right, they are basically little bit, they are still investing, but where we were 1.5, 2 years ago, it has slowed down a little bit, right? So that's a one aspect of it. Also on the founding side of it, founder side of it, I have seen many new startups, but then startups, what I have seen is that it has also slowed down a little bit, but then there are still many people coming up with that. But there is so many things are going on because you need to educate yourself with the technology. You need to see what's happening in the market. So there is lots of variability there and uncertainty there as well, right? Technology wise, if you look at it, new technologies are coming up with the speed, right? If you look at from the old days of steam engine invention to the electricity to CPU chip, and now where we are at in after dot-com era, the duration is shortening, right? Like right now we are talking about AI, but I'm pretty sure that we will talk about something amazing from quantum computing or something like that in next 1 or 2 years, right? And it's gonna very in a short term, you will start seeing more and more changes. So I think that it brings the challenges as well because it's very hard to cope up with that on a regular basis, right?
Huh,
So,
I see. Absolutely. That makes sense. So in the last few minutes that we have here, what else should we cover today?
I think We pretty much covered everything, but what I would say is that in a closing, that it's a tremendous ecosystem. It's a tremendous ecosystem. There are tons of opportunities, all those technology changes, all those other things I was talking about. Where the changes comes, it brings the opportunity as well, right? I would just say that it's need a visionary person and the capability to be brave, to make be brave and be hungry about the success, right? So all I would suggest here is that anybody who's listening, that or all the entrepreneurs, is that be brave about it and go after the vision that you have with the right set of ecosystem and experienced people like you, right? You have tremendous basically insight into this ecosystem, connectivity, connection to the lots of people or any other person can provide. So use that network to grow your business or build your business. So that's what I would basically pass it as a message.
Very good. So how best for listeners to get back in touch with you?
They can directly reach out to me through my email, vishal.arora@vidos.com, or they can also basically reach out to us through our website, vidos.com directly.
We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you so much for your time. Pleasure to be here, and I'm looking forward to seeing you sometime soon.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.